Hey, welcome to the Guaranteed Retirement Guy Show. My name's John Stevenson, and I'm going to explain how to read your annuity statement. So annuity statements come in all shapes and sizes, and it really depends on the type of annuity. You've got MYGAs, you've got variable annuities, you've got fixed annuities, you've got fixed index annuities, and the statements can be really, really confusing if you don't know how to read them. And of course, if you need help with that, book a call. There's a link below this video, and I can show you exactly what's in your statement and what it means for you personally. But basically, when you're looking at an annuity statement, let's talk about MYGAs first, okay? A MYGA is a multi-year guaranteed annuity. And if you're in one right now and you've got maybe 4 or 5% locked in for a few years and you're wondering, well, how do I read this statement? What do I need to look for? Well, here's a couple things. First is your guaranteed rate, right? What is the guaranteed rate of return? And when you get that statement each year, make sure that the actual earnings that you get are what you were promised, okay? Also, if the annuity company goes under, they will have a minimum guaranteed interest rate, which is usually 1/3 to half of what they're promising you right now. But that's only if they go under. And typically when you set this up with very, very strong B++ companies or A-rated companies, you usually never have that problem, okay? But that is definitely what you want to look for when you look at these statements. Look at the ending value, okay, the accumulated value, as well as the surrender value, okay? Those are both two different things. Okay, when you've got the accumulation value, that is the actual account balance, okay? And this is the same for fixed index annuities. If you have a fixed index annuity that is earning, let's say it's the S&P index and they're capping it at 8%. And let's say the S&P did 10%, okay? Well, you're going to be capped at 8%. And of course, if the market goes down the next year, you're not going to partake in any of those losses, which is pretty nice. So if you got $100,000 in there and let's say you earn up to the cap, that year you get 8%, you've got $108,000, okay? Now, you might have a surrender charge period as well. So you'll look at that and you'll say, all right, well, my accumulation value here is $108,000. Well, great, that's what I've got. I've earned my money, I've earned my interest, and now next year, hopefully I'll have some compounded earnings. And that's really the best part of these contracts is you have those earnings and you have that protection against market risk. All right, now what about the surrender value? So you've got the accumulation value. You need to look at the guaranteed minimum surrender value on your statement. And it usually is a little bit less because you've got surrender charges. So at the beginning of your contract, it's the highest. And it could be as high as 7, 8, 9, or even 10%. Now, if you've got a 10-year surrender charge period, that could start at a 10% surrender charge and go all the way down to 1% at year 9. And then after 10 years, it's zeroed out. You don't have any surrender charges. The other thing you have to look at as well is the MVA charge, okay? And a lot of times it will show that and sometimes it won't. An MVA charge is just a market value adjustment. And so for instance, you will receive an adjustment if you surrender your contract early. When they show you guaranteed minimum surrender value, that is also showing the actual value that you can take out minus MVA charges or positive MVA charges. That could be a plus in your account, and also minus any just surrender charges. If let's say you're in the middle of the contract and you got a 5% surrender charge and you got a $500,000 account, well, there's going to be a $25,000 surrender charge. But let's say you bought the annuity contract right now, rates are high right now. And then let's say 3 or 4 years down the road, you decide to cancel the contract, you surrender it, but interest rates are lower. And so now the value of that bond that they purchased earlier is actually greater, which means you're actually going to have a positive offset to your total accumulation value and your surrender value, which the surrender value is all that matters because that's what you actually get. So that's pretty nice. You might have let's say it's a 5% surrender charge on a $500,000 annuity. Okay. Well, you're going to have $25,000 deducted from that, just the regular surrender charge. Okay. But let's say interest rates are lower now versus when you bought the annuity earlier. Well, then you're going to have a positive adjustment. That's going to be pretty nice. Maybe that positive adjustment will take off $5,000 to $10,000 off of that surrender charge. So maybe your total surrender value is, $480,000 or $485,000 instead of $475,000, right? because you have the positive MVA adjustment as well as the surrender charge that's deducted. So when both of those are put together, it gives you your guaranteed minimum surrender value. So really, when it's all said and done, when you're looking for, hey, what can I actually take out? If I'm thinking about canceling this contract, or maybe I'm thinking about replacing it with another contract, what can I actually take out? What is my total net loss? And then, of course, I would add, if you're going to replace it, make sure that you're getting some sort of bonus. And usually it's required. You have to have some sort of premium bonus. So if I take that $485,000, it was originally $500,000, but I take $485 and I put it into a new annuity contract, but it gives me a 10% bonus. That's pretty good. I'm going to get a $48,000 bonus. I'm going to be made whole. Plus I'm going to have extra in my actual accumulation value when I open up that new contract. So I do take care of people when they are looking for replacements and when they are looking for bonuses. I put them into contracts that will give them that bonus to make them whole. But again, I would still shy away from any sort of replacement unless it's in your best interest. Okay. Don't buy an annuity contract just because someone's trying to sell it to you and they're saying, hey, it's going to be great. It's going to be a lot better than yours. Make sure you can see, all right, how is this better? Is this giving me more guaranteed income? And if that is your goal, then it might be something to look at. Okay. Is there a bonus? Am I being made whole? I have all these surrender charges. Will I be made whole when I replace it? Okay. Things to look at. All right. The other thing to look for in your statement are fees and charges. Okay. Now, if you have a fixed index annuity, you might be in an index with a booster. Well, what is that? Well, they might have, let's say, 100% participation rate in that index. 100% participation rate is you get all of it. So if it does 10%, you get 10%. Now, if you pay 1% fee for that, they might give you a boost on the participation rate. So maybe they'll double it to 200%. Well, that's pretty nice. So if the index does well, now all of a sudden you're getting 20% instead of 10, 200% times 10%. That's pretty good, but you're being charged for it. Now, the downside, of course, if the market is going down, you're going to get 200% of zero and you're going to get charged. So make sure you're looking at those fees and credits and see if they're worth it. Okay. Because if you're not getting any credits for those fees, then maybe you should get rid of those fees. Okay. Change the index around. So those fees can be eliminated if you put it into an index that does not have any fee, does not have any booster. And of course, the potential growth is lower. So, something to think about on that. There are some fees for other contracts such as variable annuities. And when you look at your, especially when I have people reach out to me who have variable contracts, they don't understand the fees. And a lot of times they don't realize how much they are paying. You've got to line item your fees out. I mean, you've got annuity fees just maybe for the rider, and maybe the advisor is charging a fee. And then maybe the mutual fund, if it's in a sub account, if it's a variable, you have fees on there. So there are lots of different fees that you could be paying that maybe you are not aware of. Okay. So make sure you look at that. Make sure you look for that. And if you're thinking to yourself, I have no idea what is going on here, John, please just look at this real quick for me so I can know. Send it over. That's fine. Email it to john@johnstevenson.com and I'll take care of it for you. Okay. Or if you want to book a call and you want to chat about the annuity that you have, maybe you want to replace it, or you're looking just to purchase a new annuity, I'd love to help you with it. Okay. There's a link below this video. Go straight to my calendar and you'll be talking with me and we'll look at all of the annuity options on the market. Okay. If you're looking for a fixed annuity, maybe a SPIA or a DIA, we'll look at those. Okay. If you're looking for a MIGA, just a fixed rate, we'll look at those. If you're looking for the highest guaranteed income for the rest of your life, usually a fixed index annuity with an income rider is the best one to choose. So, and we can look at all of those. So happy to show them all, happy to answer your questions. And of course, I'd love to help you purchase an annuity if that's what you're looking for. So again, I really appreciate you watching. I hope this channel, I hope this video has brought you a ton of content. And I hope you I hope you subscribe to my channel so that you get all of the valuable content and information I try to push out each and every week. And again, if this is valuable to you and if you need help, please don't hesitate to book a call or reach out. So thanks again for watching. And we'll see you in the next video.